It is probably one of the best times in the history of our country to invest in single-family residential real estate. Although interest rates are higher than what we've seen in the past couple of years, they are not high from a historical perspective. They're normal. Although in some markets, home values have dropped, in many other markets, home values have continued to increase at 3 to 5%. This is normal. In the past few years, there were multiple offers on almost every home being sold, and they all sold for more than asking price. Today, there is what I call blue ocean. You can make an offer on a property and expect to get it for a little below asking price. This is normal. The future of affordable single-family properties is quite simple. It's Economics 101, simple supply and demand. There is still a shortage of millions of homes for those who want and need to buy. The government ratcheted up interest rates just enough to tamper down most primary home buyers' ability to buy, and to get many investors to press pause because cash flow was lowered just enough to make them think twice. But it has done nothing to lessen the demand. It is just now pent-up demand, ready to break out the moment interest rates adjust a little lower, or as quickly as people realize that buying now has incredible benefits. Here's why today is an amazing time to be investing. The market is normal, and normal brings predictable and amazing results that beat most other investments by significant margins. Let me share a simple case study illustrating the benefits of purchasing an investment property today in the right market with right strategy versus waiting for interest rates to go down. Let's take a $300,000 home, 25% down, 5.5% interest rate versus a 7.5% interest rate. The 5.5% interest rate yields approximately $300 per month net cash flow. The higher interest rate purchase yields about $100 per month net cash flow. The difference is approximately $200 per month. That means the higher interest rate property is missing out on approximately $2,400 in net monthly cash flow. So let's say that you, the investor, says to yourself, I'm going to wait until interest rates go back down to 5.5%. And then I'm going to make my next purchase because I'm going to time things to where they're a little more ideal. Let's say that interest rates then drop down to 5.5%. You decided to wait 3 years to purchase because your cash flow was too low by $200 per month. If you could have bought today at the 5.5% interest rate, you would have made an extra $2,400 per year or $7,200 in 3 years. That's a lot of money. However, let's look at what you missed out on in order to make that extra $7,200. The great thing about single-family home real estate investing is that interest rate does not affect some of the other great benefits. In this scenario, if you would have bought this $300,000 property with 25% down at the higher interest rate of 7%, your principal pay down would still be the same of approximately $150 per month. Over 3 years, that equals $5,400. Also during this 3-year period, you would have been able to deduct another approximately $200 per month of depreciation expense, which equals $7,200 over that 3-year period. Add the two together, and that's $12,600. So now, deducting the lost cash flow, you're ahead by $5,400. But now let's look at the appreciation you missed out on over those 3 years. If you take a $300,000 property, and if we take the more conservative 3.5% appreciation, that's $10,500 per year, or $31,500 for the 3 years. Add that to the $5,400, and now you're ahead by $36,900. By saying that you wanted to wait for a lower interest rate, you've now lost out on nearly $37,000 of increase. But it's actually even more. Remember that your cash flow, even at the higher interest rate, was $100 per month. Over the 3 years, that's another $3,600. So our total is now $40,500. Deciding to wait for a slightly better interest rate has now cost you more than $40,000 in 3 years. But wait, that's not all. Now that you are buying after interest rates have fallen, all of those people who are doing the same thing as you, all of that pent-up demand is breaking loose. And they are all jumping back into the market as well and competing for the same properties as you. This makes it likely that you will have to pay a few extra $1,000 to compete against the competing offers. So let's say it's $5,000 more. Further, had you purchased when demand was low, you likely were able to get an offer accepted at a lower offer price, saving another $5,000 off the purchase price. So add $10,000 to the $40,500 you made during the 3 years of ownership, and the total is now $50,500. $50,500 is what you missed out on by waiting for a lower interest rate and the few $100s of extra cash flow that would have brought. Though you bought at the higher interest rate 3 years ago, you can now refinance to the lower interest rate and increase your cash flow. Contrary to conventional thinking, investing today is smart. if done the right way. The news media, who is trying to make headlines, would have you believe that the sky is falling again. It is not. But normal is boring and normal doesn't sell. Warren Buffett, the greatest investor in the history of the world, said, "I buy when everyone else is fearful, and I sell when everyone else is greedy." Right now, everyone is fearful, and it is a great time to be investing in single-family homes in the right markets with the right strategy.